Welcome to the Business Compass Bite-Sized Webinars series. My name is Rich Coulthard and I'm a director at Ison Harrison Solicitors, and today I'm going to be talking to you about mergers and acquisitions, some top tips and key legal considerations. Mergers and acquisitions is a vast topic, and as this is a bite-sized webinar, I'm just going to be covering some of the key points if you're a buyer thinking about acquiring a business and some of the key considerations that you might want to have. So, dealing firstly with the deal structure. So, broadly speaking, there are two ways to purchase a business. It could be an asset purchase or a share purchase. Share purchase can only apply to a limited company. And the difference really is with a share purchase, you are buying the seller's individual interest in the limited company. You take over the limited company as it is, which has both positives and negatives. So some of the positives, you won't have to assign contracts, but on the negatives, you are taking on some of the liabilities. An asset purchase is a little bit different. You're still buying the business, but you're almost picking and choosing what you want out of that business. You're buying specific assets, which could include the goodwill, the contracts, plant machinery, things like that. So two different structures, there are advantages and disadvantages to each, which I'll come on to. Question over deferred payments. I would say the majority of deal structures nowadays involve at least an element of deferred payment. So it's unlikely that you'd have to pay all of the purchase price up front, and there's various reasons for that, again, which I'll come on to, but in part it protects the buyer. We're going to talk a little bit about fixed price, locked box, and completion accounts. These are all terminology around share purchases and about how prices can be adjusted, and for clever buyers may well be a way of getting a price reduction through the back door. I'm going to talk as well a bit about management teams and the importance of having management teams in place when you're buying a business, to save you the time of having to run it, but also to help with the continuity around things like new clients, existing clients, and the practical side of running the business that you're acquiring. So briefly, difference between asset purchase and share purchase. I've already kind of touched on this, but an asset purchase is you're picking and choosing what you want to buy out the business. It could be the entire business, but crucially, you are leaving any existing liabilities, any existing problems with the seller. It is typically more advantageous to a buyer, and less tax efficient for a seller. There are some complicating factors, however. TUPE will apply in respect of the employees, for example. You'll have to assign the contracts, and some contracts have restrictions on assignment, which may make it complicated to go through an asset purchase. And in certain industries, there's going to be regulatory requirements. So, for example, if you're a healthcare business and you're regulated by the CQC, for example, most transactions in that sector are structured as share purchase because you don't then need to apply for a new registration, and applying for a new registration is particularly time consuming at this moment in time. Share purchase agreement, you take over the existing limited company, which can make it easier in terms of things like customers, particularly customers who are on a retained basis. You don't need to get them to make payments to different people, things like that. As far as the customer concerns, nothing changes. They continue to deal with the same company that they've always dealt with, but the ownership of that company is now changed. TUPE doesn't normally apply, so you don't need to go through that process, and you wouldn't normally need to assign contracts or leases, but be mindful that certain contracts may have what we call change of control provisions, so you might not be able to complete the purchase without the permission of a third party, for example, a bank or a local authority or something like that. So deferred or contingent payments. Now, this is something that buyers should be considering, and I would advocate that on most deals, or certainly most deals above a few £100,000 in value, as a buyer, you probably want to include a certain amount of deferred payments. And the reason for that is to ensure that the seller cooperates in terms of things like handing over customers, handing over bank accounts, things like that. So you've got that protection, but it also gives you some protection in respect of warranties. So when a buyer buys a business, they will expect the seller to make a large number of promises, what we call warranties, about the position of the business. So there's no disputes that they've not told you about, there's no insurance claims, the financial position of the business is what they've told you, things like that. And if those promises turn out to be incorrect, then a buyer could have a claim for breach of warranty. Now, if you've got a deferred payment, you've got some protection there, because what you normally have is a provision that if you have a claim for breach of warranty, you can automatically deduct that claim value from the deferred payments. Contingent payments is slightly different. It is a form of deferred payment, but contingent payments is normally reliant upon some sort of future event or performance of the business. So, for example, you may say, well, you can have a further earn-out payment if the income or turnover or profit or what have you of the business meets a certain target after completion, and if that target is not met, either the price will reduce, or potentially there'll be an increase in price if you exceed that target. It gives you a bit of flexibility as a buyer to give yourself both some protection, but also to keep the seller invested in ensuring a smooth transition of the business, as well as reducing the upfront cost as a buyer. Now, when you're buying a business as a share purchase, you're taking over the existing business as it is, and which we've already spoke about. Now, the business finances of a company change on a daily basis. Money coming into the business, money going out of the business, bank account balances, things like that. These all change. And this is one of the areas that more unsophisticated parties can overlook. And we typically have one of three options to then adjust the price based on the final financial position of the business as at the actual date of completion. First option is a fixed price. That is, we are paying whatever the price is that's agreed, and there's going to be no adjustment whatsoever. The downside to this is, how do you protect the buyer in terms of ensuring that tax liabilities aren't more than they're expected to, or that they've not let supplier invoices go unpaid so that that falls on you, or that they've not extracted too much cash. So from a structure perspective, it's simpler insofar as there's certainty, right, this is the price that we are paying. But the flip side to that is you probably need more warranty protection to make sure that the financial position of the business is what you expect it to be, and that the sellers haven't allowed certain liabilities to accrue and things like that, or that they've extracted certain cash from the business before completion, thereby putting the business into a worse financial position when the buyer takes over. The second option, and probably the most common option, is what we call completion accounts. So this calculates essentially the balance sheet of the position as at the date of completion, normally calculated 30, 40 days after completion. Looking backwards is essentially how much cash was in the business, how many debtors, so how much money was owed to the business, potentially the value of any stock or anything like that, less any liabilities, including tax liabilities, and what's the outcome of that, and is that figure more or less than a target position. I talked about this being an opportunity for buyers potentially being able to price reduce, because if you're doing that adjustment against a higher target, you can indirectly get a reduction in price. Most deals are structured on what we call a cash-free, debt-free basis. So the assumption under the completion accounts is that any assets in the business, or any cash or any debt is above what is required to cover the liabilities, would be paid to the seller. So, for example, if you have £100,000 worth of assets, being a combination of cash and debtors, and £50,000 worth of liabilities, £100,000 less £50,000 on a cash-free, debt-free basis, the seller would get an additional £50,000 out of the cash in the business. But as a buyer, if you set a target position, let's call it 30,000 for argument's sake, On that same calculation of £100,000 worth of assets and £50,000 worth of liabilities, gives you a net figure of 50. Well, we said that the target was 30,000, so the buyer would only have to pay an additional 20,000, being the difference between what we expected, i.e. 30,000, and what the actual result was, 50,000. So sophisticated buyers can make this a way of essentially reducing the price to a less obvious mechanism. The third option is what we call locked box. Now, this is similar to completion accounts, but the key difference being is that you fix the date for the price before completion. The advantage of this is that it gives both the parties certainty as to what the price is going to be, because you agree what the financial position is before completion. The downside in practice is that the parties can then spend a lot of time agreeing what happens in terms of the finances of the business after an agreed date, i.e. who gets the benefits, what we call leakage, permitted leakage, things like that. So whilst in theory it is a good idea, in practice can be a little bit more problematic, but is an option for the parties. So broadly speaking, the process, and I'm not going to go through all of them in order, but essentially you set outside what the structure of the deal is, how much you're going to get paid, when you're going to pay it, things like that. And then that would get put together in a heads of terms. Heads of terms are not generally binding, but essentially set out the structure of the deal and may have protection around things such as exclusivity, so that the seller can't start negotiating with someone else for a period of time, confidentiality, and dealing with things like costs if one party pulls out of the transaction having agreed the deal in principle. Due diligence, this is where the buyer makes inquiries into the business to make sure that they are buying what they expect that they're buying. The sales contract, warranties and indemnities, so these are protection that the buyers get about the position of the business, the disclosure process, and then post-completion. So, legal due diligence. The starting point to understand is that for as a buyer, we have a principle called caveat emptor, which basically means buyer beware. It's very little we call common law protection for a buyer in the event that they buy a business and it isn't what they expected. So as a buyer, what you would normally do is a due diligence process to look into the position of the business and make sure that they iron out any problems that they think there may be. So these are broadly some of the topics you'll probably want to look at as a buyer. So they broadly encompass finance and liabilities, accounting information, employees, properties, contracts, customers, compliance, and the like. And when we're instructed for a buyer, we have a very long questionnaire that we send to sellers, asking them to provide us with all sorts of information so that we can then assess where there may be potential risks to you as a buyer. But the key protection for any buyer is what we call warranties and indemnities. Now, warranties are contractual promises, and they're fairly extensive. A standard share purchase agreement will quite easily have 20-30 pages worth of promises covering everything from employees to financial information, insurance, disputes, compliance, properties, data protection. There's the IT. There's a full range of things that are in there. And these are general promises that a seller makes about the position of the business. And if those promises turn out to be incorrect, a buyer can have a claim for breach of warranty. The warranties are generally qualified by what we call disclosures. So, for example, there'd probably be a warranty saying that there are no employees on maternity or paternity leave. So the buyer can buy a business assuming that that statement is correct. If, however, business that is being acquired had an employee on maternity leave, for example, the disclosure letter would say, actually, this warranty is not correct, and Mrs. Jones or whoever it's going to be is on maternity leave and is expected to return on whatever date. Provided the seller has made that disclosure, there wouldn't be a claim for breach of warranty. Warranties are also normally subject to financial limitations, so normally there has to be a minimum level of financial loss for a buyer to be able to claim for breach of warranty, and there'll also be time limits around claiming for that. Indemnities are a level above warranties. So indemnities are normally for specific known risks. For example, if you're acquiring a business and one of the employees was pursuing, I should say, an employment tribunal claim, you would probably want an indemnity saying that the seller has to pay any costs or damages arising in respect of that claim. And they are covering everything in respect of that. So normally, it covers specific known risks, such as claims, such as maybe a specific tax liability or something like that. And this might be a reason to have either a deferred payment or a retention or even a price reduction if we know there's a particular problem. In certain situations, if we're acting for a buyer, you may want to try and get away with saying that all warranties constitute an indemnity. Many buyers' solicitors will pick up on this and will probably get objected to, but it may be worth a try. The key advantage of an indemnity over a warranty is the assumption is that the seller is paying everything. There's no need normally to meet a minimum financial degree of loss. It covers all costs, all liabilities, all the rest of it, but it's normally for specific known risks. So when you're going through the due diligence process, these are some of the documents that you're going to want to see. 3 years accounts, bank statements normally for a year or two. Any finance agreements, if there's any bank loans, vehicle finance, hire purchase agreements, finance on plant or machinery, you need to know all of this and know the terms. Quite a lot of those agreements will have change of control provisions, so there might be a requirement to have approval from a third party before you complete a transaction. Obviously, employee information in the vast majority of business transactions, whether it's a share purchase or an asset purchase, you're probably going to be assuming the employees. So you need to understand who they are, what they do, what their salary is, things like that. Obviously, supplier contracts and customer contracts. Customer contracts in particular is really quite important to understand what business you're going to be able to retain post completion. Any leases and what we call CPSE forms. So these are commercial property standard inquiries. Similar if you have ever purchased a residential property, a seller will complete normally the Law Society property information form. This is quite similar to that, but much more extensive because it covers commercial property. Lastly, in some ways, most importantly, is if you're in a regulated sector, such as CQC, Ofsted, FCA, SRA, or what have you, many transactions will require some form of approval or some sort of notification to a regulator about the change of control or potentially permission for that change of control. So you need to make sure that that is covered off. Some of the potential problems that we see in transactions. Landlords typically can be more problematic. They're not directly invested in the transaction one way or another. So they don't have any great desire for the transaction to go through. They may have a tenant who's been paying them perfectly well for a number of years and maybe reticent about allowing another tenant in. So landlords can be problematic. Commercial funding for deal. I'm going to come a bit more into commercial funding, but you need to get that position right early on. Commercial funding, whilst widely available, we certainly seeing that the extent of the inquiries and the requirements of lenders have become much more onerous over recent years. Finance and liabilities. So understanding actually what's the buyer willing to take on. Is there things like invoice finance facilities? They can be problematic to transfer and can be difficult to get out of. Motor vehicles, that's something we see quite often, sellers putting what they consider to be their personal motor vehicle through the business, but then when they come to sell the business, of course, that is an asset of the company. We need to extract that, or there might be a lease involved, things like that. Disorganized or uncooperative sellers. The extent of the information that we will ask for on behalf of a buyer from a seller is extensive, and some sellers are not prepared for this, and it can come as a bit of a surprise and can cause issues getting that information. I've already said that we would typically recommend deferred payments for a buyer. There's often a thorny issue around security on the deferred payments. From a seller's perspective, they want more security. They may want things like debentures or personal guarantees or charged over shares. And from a buyer's perspective, you obviously want to try and give as much security, as little security as possible, not because of necessarily any intention not to pay them, but just because you prefer not to be tied up in that way. And as I said, regulatory issues, certain regulated sectors, the regulators are particularly slow in dealing with these matters. In certain sectors, in certain niche sectors, there's certain national security um, uh, legislation that we may need to go to the government essentially for permission for the transaction if the business you're acquiring is in a sector that relates to certain infrastructure or certain defence type contracts. Legal inquiries for and security for lenders specifically. Lenders will want to go through their own due diligence process. This might include valuing a property. It might include doing an assessment of a debtor book, for example, as well as legal inquiries into the business itself, the identity of the buyer. They may want to get a buyer to take independent advice on personal guarantees or take security from other companies owned by a buyer. There might well be multiple creditors. We've certainly had this before where we've acquired a business and a certain amount of security was staying with the existing bank, for example, maybe an overdraft or something like that, or an invoice finance facility, but then a new funder was giving finance, let's say, in respect of a property, and then can be the need for the lenders and the lender solicitors to liaise as to who's got priority over what debt. This can all add time and cost to the process. So understanding your funding as early as possible in the process is absolutely essential. And having the assistance of a good commercial finance broker could certainly help smooth the way in respect of that. So finally, some top tips if you're thinking about acquiring a business. And firstly, obviously identify the right target. Target that might be complementary to an existing business that you've got, where you can add value. For example, might be a sector that you're involved in. Doesn't have to be. We see an act for clients who are buying businesses essentially as investments, very similar to people who are buying property as investments. So it's particularly relevant, for example, where there's an existing management team. But you need to understand the right type of business, and there are business and deals out there where you can get a better value. Sellers who are particularly motivated to sell, for example. Understanding your deal structure and your funding options, that's absolutely imperative. Again, I've talked about things like completion accounts and target working capital, target net asset positions. These are all options to ultimately try and get the best deal possible for you as a buyer, and then understanding how you're going to be able to fund that. It is possible in many scenarios to be able to use existing assets within the business, maybe property or plant and machinery or existing debtor books, for example, to help fund the purchase price. But you need to understand your options around that and take expert advice to help put that deal structure together. Plan who will run the business. If you've got an existing business or your attention is elsewhere, you need to be thinking about actually who's going to run the day-to-day operations. Is there a management team in place? And if there is a management team in place, how are you going to incentivize them to stay in the business? If you've got a key sales director, for example, who has got all of the customer relationships, it's inevitably going to be imperative to you as a buyer that you make sure that that person is incentivized to stay in the business in the long term. Making sure you've got appropriate warranty indemnity protection, as we've already discussed, and that involves a thorough due diligence process to understand where the risks are and how we can protect against that. You need to factor in your lender costs and also timetables for the deal and your overall budget. Bearing in mind when you're acquiring a business, in many situations you will also have to pay stamp duty to HMRC. That might be stamp duty on shares, which is charged at 0.5% of the value of the transaction, or it could be stamp duty land tax, which is at a staggered rate depending on the value of the property. And finally, for anyone looking to acquire businesses, I would always say You also need to have one eye on your own exit. How are you going to maximize the value of the business? And that could be by building a bigger group of complementary businesses, and that typically will result in you getting a higher multiple on the sale of your own business. Do you need to think about something like an employee ownership trust or a management buyout? But actually, ultimately, understanding how you're going to realize the value that you're building out of businesses that you're acquiring, how to maximize that value will ultimately help you achieve your own goals and the maximum value and return for your investment on these matters. As you can see, mergers and acquisitions is a complicated topic. I've talked in very general terms about a wide range of issues. If you do need advice or have got specific questions around deals that you're considering, or perhaps deals that you're involved in, or would like to have help in finding deals that meet your criteria, I'm available to speak to. You can call me on the number on screen or drop me an email with any questions that you may have. I'll be more than happy to have a chat and a consultation to see how we may be able to help you with the matter. Thank you for joining us today here on the Business Compass Bite-Sized webinars. Again, my name is Richard Coulthard of Ison Harrison Solicitors. It's been great to have you along today, and thank you for your time.